Hello folks, this is Cam Mader from Mader Wealth with an educational economic update for January 2019. In this month's video, I'll discuss some of the major headlines that influenced markets in December. I will also provide insight into what those developments could mean for you as an investor. Please stay tuned at the end of this video for a required disclosure statement. So, how do we close out 2018? To put it bluntly, December was a challenging, volatile month for stocks, as equities also ricocheted between losses and gains. Want an illustration of how dramatic the turbulence was? Consider the Dow's performance on the days surrounding Christmas. First, the Dow experienced its worst Christmas Eve in history. Then the very next trading day, the index posted its largest point gain ever. That experience was pretty much December 2018 in a nutshell. In fact, despite positive returns on the year's final trading day, the Dow and S&P 500 had their worst December results since 1931. All three major domestic indices also had their worst annual returns in a decade. In 2018, the S&P 500 lost 6.2%, the Dow declined 5.6%, and the Nasdaq gave back 3.9%. Just a few months ago, the indices were reaching new record highs. Why the about face? Many investors sold off stocks in reactions to worries about the economic growth, the Federal Reserve's policy, and ongoing trade tension. However, that answer could oversimplify the situation. Some people blamed computer-generated trading for the intense fluctuations. Others said, well, we're in a period of hypersensitivity to headlines. Of course, investors had many headlines to digest, including a government shutdown that was on its 10th day by New Year's Eve. You know, we want to stop and take a moment to look beyond the biggest headlines and see what the data told us in December. In the latest readings, we learned that personal income was up 4.2% over the same time in 2017. The manufacturing and services sector both beat expectations. The economy also grew at a 3.4 annualized rate in the third quarter. That reading was slightly lower than initial projections, but at the same time, only one quarter had faster growth in the past 4 years, the second quarter of 2018. In other words, several data points are showing that beneath the market gyrations, the economy is still strong. Federal Reserve Chairman Powell echoed these sentiments when announcing interest rate increases in December. More concerns might be here, and the markets might not like the interest rate increases. But by the Fed's assessment, our current circumstances indicate a very healthy economy. In the new year ahead, we will continue to monitor the markets, real risks, and opportunities. One thing that won't sway us, however, are the headlines. That's it for this month's educational economic update. Once again, this is Cam Mader with Mader Wealth, signing off for the month of January 2019. Please remember that nothing we talk about here is a recommendation. If you'd like to discuss your personal financial situation, please give us a call at 651-379-0456. We'd be happy to talk to you. While we believe this information in this report is reliable, we cannot guarantee its accuracy. Opinions expressed are subject to change without notice and are not intended as investment advice or a solution for the purchase or sale of any security. Please consult your financial professional before making any investment decision. We know investing involves risk, including the potential loss of principal. No investment strategy can guarantee a profit or protect against loss in periods of declining markets. The indices mentioned are unmanaged and cannot be invested into directly. Past performance does not guarantee future results. The modern design of the S&P 500 stock index was first launched in 1957. Performance back to 1931 incorporates the performance of the predecessor index, the S&P 90.